Imagine you are sitting behind the wheel of like a really high-performance sports car.
Okay.
The engine is roaring, you've got your foot pressing down hard on the gas, but the windshield is completely blacked out.
Oh, wow.
Yeah, you cannot see a single inch of the road ahead of you. To steer, to figure out where you are going at 80 miles an hour, you can literally only look at where you've already been by just staring intensely into the rearview mirror.
Which sounds completely terrifying, honestly.
Right. It sounds insane. But in the financial world, billions of dollars are being steered exactly like this.
Yeah, I mean, it's the ultimate paradox of the modern market. We are trusting these incredibly complex algorithms to drive our wealth into the future, but those algorithms are entirely blind to tomorrow. They're, obsessed only with yesterday.
And today, we are popping the hood on one of these machines. This is a special viewer-requested time and market deep dive, and we are putting the Smart Trend 25 ETF under the microscope. The ticker symbol for this one is STRN.
STRN, right.
We're going to strip this fund down to its chassis, see if its performance actually justifies its price tag, and figure out what handing the keys over to a momentum algorithm really means for your portfolio.
It's a fascinating one to look at.
It really is. But before we hit the gas, just a quick reminder for you listening. This deep dive is strictly for entertainment purposes. We are unpacking the data and the underlying strategies, but, you should always seek professional financial advice before making any big moves with your money.
Definitely.
Okay, let's unpack this. To get us started, just give us the plain English blueprint of what STRN actually is because, well, this fund only hit the market in August of 2025.
Right. So at its core, STRN is an actively managed exchange-traded fund, and it's focused on large-cap U.S. equities. But it completely rejects the traditional approach of, just buying the whole market and holding it.
The usual index strategy.
Exactly. Instead, it deploys this proprietary quantitative ranking system to aggressively chase whatever is currently going up. It is a pure, unapologetic, trend-following, momentum-based fund.
The rearview mirror strategy.
Exactly.
But before we look at the returns, we really have to understand the engine here. If you buy a share of STRN, what is that algorithm actually doing behind the scenes every single day?
So it operates through a pretty ruthless funnel. It begins with a massive universe, the 800 largest U.S. equities.
Okay, that's a lot.
It is. But from there, it immediately amputates the bottom half. It throws out 400 companies based on a hybrid scan of stock price momentum and intrinsic value analysis.
Oh, so it does look at value a little bit at first.
A little bit, yeah. It establishes a baseline of quality, which leaves you with 400 stocks.
But I mean, 400 companies is still a massive, sprawling portfolio.
Yeah.
You aren't getting, hyper growth out of an index that wide.
Right, which is why the algorithm gets much more aggressive in the next step. It takes those remaining 400 and applies a really strict quantitative ranking system and filters them down to the top 25%.
Wow.
And at this stage, it abandons intrinsic value entirely. It looks strictly at historical price momentum and performance trends. Finally, it isolates just 25 stocks and weights them by market capitalization.
So the bigger the company, the heavier its weight in your portfolio.
Exactly.
But hold on, if we were market cap weighting the top 25 momentum stocks in the U.S. right now, aren't you essentially just building a fund of the 5 biggest tech monopolies and a few hangers-on? How does it avoid just becoming a trillion-dollar tech echo chamber?
Well, they do program in a few essential guardrails. So the algorithm enforces a strict 8% cap on any single individual stock and a 30% cap on any single sector.
Okay.
Yeah, so if a stock surges and hits 9% of the portfolio, the fund is forced to trim it back down. But make no mistake, even with those caps, you are looking at a highly concentrated, hyper-focused portfolio. You are holding a maximum of 25 stocks at any given second.
And looking at the top holdings really brings that concentration into stark reality.
Yeah.
You've got the usual suspects, right? Alphabet, Amazon, Dell.
Yeah, the heavy hitters.
It is incredibly heavy in technology and communication services. But then you see names like Vertiv, Micron, Eli Lilly, and GE Vernova.
Right.
And Eli Lilly is pharma, right? Riding the whole weight loss drug wave. And GE Vernova is power grids. This perfectly illustrates the point, I think. The algorithm doesn't care about the industry, it doesn't care about the product, and it certainly doesn't care about the CEO's vision.
No, not at all. It only cares about the chart. It is entirely agnostic to the narrative, and that is really what separates it from traditional analysis.
But let me push back on this for a second, because, well, every instinct I have And really, every piece of financial advice we've all been fed since day one says buy low, sell high. You look for bargains.
Sure, yeah.
But this algorithm is literally doing the opposite. It cuts the list to the top 25%, meaning we are explicitly buying stocks that have already surged.
Yeah.
We are buying at the absolute top of the market and just, hoping it goes higher? How is this not just a recipe for buying into bubbles?
What's fascinating here is how the research from the Makeda Investment Group frames this exact dynamic. They analyze these strategies under the umbrella of alternative betas, and they draw a hard line in the sand between value investing and momentum investing.
Okay.
They are fundamentally opposing philosophies. Value investing is anchored in accounting. You are, diving into the spreadsheets, evaluating cash flows, dissecting the book value, and looking for a company that the market has incorrectly priced. You are looking for that bargain.
A rational approach. You find a dollar being sold for 80 cents.
Right. But momentum investing argues that the market isn't rational at all. It argues the market is deeply emotional.
Okay, yeah.
Momentum strategies completely ignore the spreadsheet. They are defined solely by price action. It is a calculated bet on human behavioral finance, specifically the persistence of herd mentality.
FOMO, basically.
Exactly. The theory is that when a stock starts moving up, investors underreact at first. Then they notice the trend, FOMO kicks in, and the herd rushes in, pushing the price far beyond its rational spreadsheet value. You aren't buying the intrinsic value of the company. You are buying the psychological momentum of the crowd.
Here's where it gets really interesting, because the million-dollar question is, does betting on the herd actually pay off?
Right.
And looking at the raw data, the herd is stamping hard right now.
Yeah.
Currently, STRN is trading around $27.87 a share.
Okay.
Since it launched in August 2025, it's up roughly 22%. And looking at the year-to-date performance for 2026, it is posting double-digit growth. It's tracking between 10.7% and 18.9% depending on the exact daily metric.
That's a huge swing.
It is drastically outperforming the broader market. So the rearview mirror strategy is objectively winning the race right now.
You really cannot argue with the raw trajectory. But you have to remember, you don't get 22% returns in a few months for free.
No, definitely not.
Whenever an asset climbs that quickly, the underlying valuation multiples stretch to accommodate it. And with STRN, you are paying an incredible premium to ride that momentum.
So let's talk about that premium, because this is where the rubber meets the road for anyone thinking about adding this to their brokerage account.
Yeah. The multiples are running exceptionally hot. Depending on the daily data pull, the price to earnings, or PE ratio, is sitting somewhere between 36 and 39.
Wow.
And the forward PE is hovering at 25.7. The price to book is way up there at 8.6.
We have to pause on those numbers. A PE of 39 in a market environment where interest rates are still a major factor is staggering.
It really is.
It means investors are willing to pay $39 for a single dollar of current earnings. But even more telling is that forward PE of 25.7. That implies the market expects these 25 specific companies to execute their growth strategies flawlessly over the next several years.
Exactly.
There's absolutely zero margin of safety priced into those numbers.
Zero. And it's entirely by design, because the algorithm mandates that you buy the market's biggest recent winners. And because those winners have been concentrated in high-flying tech and hype-driven sectors, you are systematically forced to buy expensive stocks.
Oh, so it's a feature, not a bug.
Exactly. The PE isn't a glitch. It's the intended output of the momentum formula. You are paying top dollar for the velocity.
Okay, so we need to put STRN into the ring with the undisputed heavyweight champion of passive investing, SPY, the S&P 500 ETF.
Benchmark.
Right. If someone is weighing this momentum algorithm against traditional broad market reality, how do the two actually compare?
It is the perfect philosophical cage match, really. On purely short-term performance, STRN is currently the victor.
By a lot.
Yeah. SPY is sitting on a year-to-date return of around 5.7% to 9.7%. STRN is nearly doubling that in some tracking windows.
But the structural foundation of those returns couldn't be more different.
Exactly. SPY is a reflection of the entire U.S. economy. It gives you massive diversification across 500 companies, spanning every sector, from utility companies in Ohio to tech giants in Silicon Valley.
Right, it's broad.
STRN is a hyper-concentrated surgical strike on just 25 companies. If the tech and communication sectors catch a cold, SPY barely sneezes, but STRN ends up in the ICU.
And then we have to look at the toll booth.
Yeah.
This is a massive factor that retail investors often overlook when they see those shiny double-digit returns.
Oh, with the fees.
Yeah, SPY charges an expense ratio of 0.10%. It is virtually free to own.
Right.
But STRN, because it requires constant algorithmic recalculations, active management, and proprietary quantitative models, hits you with a 0.59% fee.
Which doesn't sound like a lot at first glance.
Right, 0.5%.
But over a 20-year investing horizon, the compounding effect of an additional 0.5% fee is devastating to total returns. You have to believe with absolute certainty that this algorithm will consistently outsmart the broader market by more than 0.59% every single year, just to break even on the added cost.
Which naturally leads us to the structural risks. We have high fees, staggering valuations, and hyper-concentration.
Yep.
The bull case numbers look great on paper today, but we really need to talk about the hidden friction inside a fund like this.
If we connect this to the bigger picture, the most insidious risk isn't even the expense ratio we just talked about. The Makita paper outlines a concept known as performance drag.
Break that down for us, because this is an invisible tax. This doesn't show up as a line item on your monthly brokerage statement.
Not at all. To maintain its momentum profile, STRN has to constantly reevaluate its holdings. Every month, the algorithm looks at the 25 stocks. If a few of them have lost their momentum and started trading sideways, the algorithm ruthlessly purges them and buys the new rising stars.
So it creates an incredibly high turnover rate.
Exactly. They are constantly trading. And trading isn't free. Even for large institutional funds, every time you buy and sell, you cross the bid-ask spread.
Right.
You incur trading fees, market impact costs, and slippage. When a fund is churning its portfolio that aggressively, those microtransactions compound. It acts as a literal drag on the fund's overall performance. You are bleeding fractions of a percent constantly just to keep the engine running.
Okay, so performance drag is the day-to-day friction. It's an annoyance. But what happens when the road suddenly washes out? The market isn't a perpetual motion machine.
Unfortunately not.
I'm looking at the insights from the return stack paper regarding market crises, and it paints a very specific and frankly terrifying two-act pattern for trend-following strategies.
This is the single most vital concept for anyone holding a momentum fund to grasp. Trend-following algorithms are fundamentally reactionary. When the market experiences a sudden, violent shock, a black swan event, an unexpected interest rate hike, a geopolitical crisis, momentum funds get caught entirely flat-footed.
Fact 1. The first punch.
The first punch is brutal. Because the algorithm relies on historical data, the data on the day before the crash was screaming, buy. The fund is heavily concentrated in the most inflated, high-flying stocks of the previous bull run.
Right, the ones with the most momentum.
Exactly. So when the market suddenly gaps down, the fund takes the full, unmitigated impact of that drop. The algorithm doesn't know the world has changed yet. It's programmed to look at the last few months, not the morning news.
It's exactly like steering a massive loaded cargo ship.
That's a great way to put it.
You are cruising at top speed. Suddenly, an iceberg appears out of the fog dead ahead. That's the first punch. You cannot just spin the wheel and dodge it in an instant. The ship's physical momentum carries it forward, straight into the danger.
Yeah.
A systematic algorithm is like a highly disciplined crew. It will eventually recognize the new structural downtrend, it will slowly turn the ship, and it will navigate to protect you. But trend following only protects you in the prolonged, grinding bear market. It does absolutely nothing to save you from the initial collision.
And the historical data in the return-stacked analysis backs that up perfectly. In a prolonged crisis, after taking that initial beating, trend-following models eventually catch up. They reallocate, sometimes even moving to defensive postures, and have historically provided massive diversification benefits, while traditional portfolios slowly bleed to death over a year or two.
But to get that benefit, you have to survive the first month.
You do.
So if your retirement or your primary wealth is riding on this, you have to ask yourself a very tough psychological question. Can your stomach handle a 25% or 30% drop in the first few weeks of a market crash, knowing that the algorithm is essentially frozen until its next rebalancing period?
It's a lot to ask of a normal investor.
Can you resist the urge to panic sell at the absolute bottom while you wait for the machine to realize the paradigm has shifted?
It requires an iron stomach. The behavior of the investor often undermines the math of the algorithm. If you pull your money out during the first punch, you lock in the catastrophic loss and completely miss the algorithm's eventual defensive pivot.
So what does this all mean? We've looked at the aggressive mechanics, the massive double-digit returns, the hidden performance drag, and the chilling reality of that first punch.
Right.
How do we synthesize all of this conflicting data into an actionable perspective? Because the analyst sentiment on STRN right now seems completely schizophrenic.
It really is a tale of two entirely different metrics. When you look at platforms like investing.com, their technical indicators are flashing a blindingly bright buy signal.
Which makes sense. The chart is pointing up, the moving averages are crossing, momentum begets momentum.
But if you flip over to the fundamental health rating on that exact same platform, STRN is labeled as weak.
Oh, wow, so a total split.
Exactly. The fundamentals are screaming caution. The PE of 39, the lack of a margin of safety, the hyper-concentration in 25 stocks, it all points to a fragile underlying structure. The technicals tell you to jump on the train, while the fundamentals are warning you the bridge ahead might be out.
This raises an important question. How does a retail investor actually use a tool with such a split personality? Where does a fund that is technically strong but fundamentally fragile belong in a normal person's portfolio?
We can draw a brilliant parallel from the source material covering the top 20 ESG ETFs. When analysts look at highly concentrated thematic ESG funds, say an ETF that exclusively buys emerging market clean energy companies, they don't treat them like normal index funds.
Because those thematic funds are notorious for rocketing up 80% one year and then collapsing 40% the next when, government subsidies change or supply chains freeze.
Exactly the same volatility profile. The consensus in portfolio construction is that hyper-concentrated, high-velocity funds like STRN must be treated strictly as satellite positions.
Right.
Your core holding, the foundation of your wealth, should be your SPY. It's the broad, highly diversified, low-cost anchor. It moves slowly and reliably. STRN is the satellite that orbits that core.
And as a rule of thumb, a satellite position is usually sized so that if it takes that massive first punch and loses a third of its value in a week, it doesn't derail your retirement.
Yes.
It's the money you're willing to risk for that 30% to 60% upside in a raging bull market, but it's not the money you need to pay your mortgage next year.
It is an aggressive tactical overlay, not a foundational strategy. You are buying a highly tuned, high-maintenance sports car. You don't use it to commute in the snow.
So let's bring all the pieces of this puzzle together. The Smart Trend 25 ETF is a razor-sharp, aggressive instrument designed to capture the absolute peak of large-cap momentum.
Yeah.
It is currently humiliating the S&P 500 in short-term performance. But you're paying a hefty premium, a 0.59% management fee, for a strategy that relies entirely on human herd behavior.
Which is unpredictable.
Very. It suffers from a continuous internal performance drag due to algorithmic trading friction, and by its very nature, it will get caught completely off guard and take a devastating hit during sudden market reversals.
It is a machine that does exactly what is it programmed to do. The risk lies entirely in whether the investor understands the limitations of that programming.
Which leads me to the thought I really want you to ponder long after this deep dive ends. As algorithmic trend-following ETFs like STRN become cheaper to run and more popular among everyday investors, what happens to the broader stock market when a massive portion of the capital is just reacting to everyone else's momentum?
That's a huge question.
Think about the underlying mechanics. If the machines are just following the trends created by other machines, who is actually doing the fundamental research? Who is setting the real value of these companies? If billions of dollars are being driven purely by staring into the rearview mirror, who is actually watching the road?
A profound and frankly unsettling question about the future of price discovery.
Thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking under the hood of your investments, and we'll see you next time.